A follow-up to yesterday's conversation about bonds, which were the focus again today alongside the dollar. That was the big move in today's session, was the greenback ripping. And once again, it was the early tell that we were going to reverse a lot of stuff. So if you're watching Morning Trade Live, then it would have worked. Because the number, firstly, was okay, fine for inflation. But the point yesterday that I made was that it probably needed to come in cool for us to avoid bonds kind of becoming a problem again. And I'm not sure we're there yet. The Russell had an issue with it, but the rate-sensitive stuff is one story. You're going to have to get further extension of yields and some more violent moves, I think, for the S&P 500 to really care. But it is kind of looking like we're going to go that way at some point. We'll monitor the relationship between stocks and bonds in a very honest way to make sure we don't get too scared about what's happening in treasuries. But I do think kind of most things add up here. Given our conversations today, a lot of good competing points on whether or not Trump policy will be inflationary or deflationary. But I think right now the needle probably, just when you combine everything, is leaning inflationary, just because you don't need a lot of Trump policy to explain it. And this is what I've been trying to hit now since the September low in yields, is that the economic situation alone, combined with the Fed's determination to lower rates, is creating a pretty fertile environment for the economy. Not that it's not what the Fed should have done, but at this point it's looking like probably they should take it piecemeal, step by step. And so this morning's initial shift, 80% to a December cut after inflation print that still showed plenty of inflation and a little bit of a tick up, just didn't really make that much sense. To me, it looks like December should be more like a coin flip still. So the red light on bonds is very, very bright. And when you zoom out on the dollar versus yields chart, which again has been your tell, this morning when we saw the dollar going back positive, that indicated that bonds were likely to start selling off and yields would follow. Look at these two. They do not get out of sync for long. And the dollar move now is getting pretty extreme. The bond move, though, is not that extreme. In fact, the 10-year yield is still sitting below where we were on the day of the election. By the way, another argument in favor of the notion that Trump policy is less relevant for bonds than it is for the dollar. I do think the dollar's got some extra kick in it right now because of tariffs, which according to Brent Johnson's milkshake theory, anything that pushes down other sovereign states in favor of the U.S. economy is just going to have a reflexive effect on the dollar that's very powerful. So that's why it's so hard to short the dollar in general. But right now, the fact that the dollar turned around on inflation today could not be ignored. That does imply that the Fed should probably take a little bit of a break here with the cuts until we get some more information on either what the incoming administration is going to do or if the economy is going to see price moving back to the upside, because some of the housing stuff, too, that's supposed to be cooling off, that everybody argues is going to be so disinflationary and deflationary, it's kind of sticking around a little bit. So I would generally watch this chart very closely. If the dollar breaks out past those little humps, this is a 5-year chart, that means it is really rocking again. And the only other time we got that was coming into a year in which we had to hike rates a bunch. So the dollar bottomed out in 21 and then peaked out in 22. So if it starts going vertical again, this really only happens when the economy is in strong condition, strong enough to influence some inflation that then might force the Fed to either have to stop cutting at least. We don't think we have to talk about hikes yet. But that's the point while we'll watch to see how stocks interplay with it. Right now, rate-sensitive stuff is going to stay rate-sensitive. The rest of the market is in this kind of euphoric mode that's just, ride it until it turns around. But we do need to, I think, consider the reality that bonds are probably going to become a problem again. So, have a great night.